Live from London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. Oil slides, stocks rebound as President Trump says the war in Iran will be over, quote, very soon, though not this week. The U.S. president says he may lift some oil sanctions to ease prices, acknowledging he discussed the topic with Russia's Vladimir Putin. Plus, Saudi Aramco approves a $3 billion share buyback as the world's biggest oil exporter faces new challenges. We're also live at Volkswagen's headquarters in its full-year earnings. Let's take a look at these markets then, because we saw a big slide in oil, and in fact that's continuing today. This market taking a lot of solace in the fact that President Trump and President Putin seem to have spoken about potentially waiving some of those oil sanctions. Also the idea that this war might be over soon, although what that even means at this point is so unclear. We have Brent crude trading around 93, New York crude above 88 but well below 90. One oil trader told us yesterday that it was absolute panic buying and selling in the market. But you can also see it in yields, because that 10-year yield was close to 4.20 yesterday. We're right back down to 4.11. So some of those really embedded inflation concerns do seem to be coming out of this market. Let's take a look at equity index futures, because we saw a massive bounce in the SOX index yesterday. Semiconductors just ran away with the day, particularly towards the close, a lot of buying. So we had the S&P and the NASDAQ higher on the session. The NASDAQ was up almost 1.5%. Eurostoxx 50 also pointing to gains. Maybe we had enough buying yesterday, though. We have, at least for right now, the S&P futures pointing to declines. The dollar index as well also showing some calm, with some of that risk trade coming out of the market. All right, your risk events today then. European finance ministers meet in Brussels. And then at 2 p.m. UK time, we get US existing home sales. After market, also another big one for the United States in particular. And that tech trade, Oracle, comes out with its earnings. U.S. President Donald Trump has predicted that the war with Iran would resolve, quote, very soon, though he said he didn't believe the conflict would be over this week. He also pledged that the U.S. Navy would escort tankers through the Strait of Hormuz.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
You're talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
For more now, let's bring in Bloomberg's Jumana Bersecci. Jumana, there's a very obvious sense in the market that there might be some kind of calm here. But is that the sense in the region, that this war might be, quote, over soon?
Well, certainly the market is reacting to President Trump's comments overnight. And to be clear, he is giving some signal that we may be getting close to the end of the war, that the war is, quote, complete. But then later on in comments, he backtracked a little bit. When he was asked by a reporter whether the war would be over this week, he said no, soon, very, very soon. And at the same time, he also acknowledged the fact that they're not going to relent until the enemy is totally and decisively defeated. So perhaps taking note of all of the volatility that we've seen in oil markets and energy markets, and the likely repercussions that could have on U.S. consumers, because he also went one step further and also threatened Iran and said that they're going to hit back 20 times harder if Iran doesn't allow for the safe passage of vessels throughout the Strait of Hormuz here. He's also talked about the possibility of waiving some sanctions. He had a phone call with President Putin yesterday, a 1-hour phone call. This is the first time they've actually spoken this year. And on the back of that, he's floated the idea of also waiving sanctions as well. This is something that we spoke about last week, and that India have also received a bit of a waiver in terms of their ability to buy Russian oil. So they're definitely, the Trump administration is looking at various measures to help bring some support to this market and ease the pain on ultimate U.S. consumers if price hikes continue to go up. But at the same time, you speak to people from the region, they say as long as the Strait of Hormuz is effectively closed, you're going to continue to see physical supply disruption. And that is exactly what came through yesterday. Another major, the biggest OPEC producer, Saudi Arabia, saying that they too have had to start limiting production because their storage capacities are going up. And at the same time, energy infrastructure continues to be targeted. So yes, there is some jawboning coming through from President Trump, but I would say that broadly speaking, the perspective from the region is take it with a pinch of salt and watch what happens as opposed to watch what is said.
Right, yeah, exactly. Now, Iran also, at least rhetorically, continuing to be defiant. What's the latest in terms of, attacks?
I'm going to draw you to a post that the foreign minister, Arakshi, put up about 8 hours ago, saying nobody should complain if our powerful missiles destroy U.S. systems wherever they are in retribution. They are still being defiant. This is something that we spoke about yesterday with the appointment of the new supreme leader, the son of the former supreme leader, just as a hardliner. They keep threatening to retaliate on any country that's hosting U.S. assets. And yes, we've also spoken about the frequency and the scale of the attacks diminishing, particularly as it pertains to the UAE. But that does not mean that they're not still causing a lot of damage. Overnight, Bahrain once again has been the recipient of many of these incoming projectiles. Residential buildings continue to get hit. Another civilian, a Bahraini civilian, dead overnight. This is after 32 being injured the day before. Over here in the UAE, about an hour before the show, we also had an incoming missile alert come through to us. So again, there's still threats there. Saudi Arabia is still reporting, again, intercepted missiles being directed both at the oil fields and over their diplomatic quarters. Yesterday, we spoke about the U.S. State Department advising and urging non-essential personnel to leave Saudi Arabia. And then, again, reports of more intercepted strikes as well over Kuwait. So Iran continued to retaliate, not just against Israel, which received a barrage of missiles too overnight, but also more broadly across the Gulf region. And the message from them continues to be one of defiance.
Jumana, thank you so much. That is Bloomberg's Jumana Bersechi in Dubai. Let's turn to the whipsawing oil market and production disruption in the Middle East. Joining me now is Bloomberg's Dan Murtaugh. Dan, what would it actually take to stabilize prices from here? We did have the G7 ministers saying they'd be ready to release maybe 200 to 300 million barrels of oil, for example. Would that do it?
A reserve release would be certainly welcome in terms of getting some oil to much needed markets in Southeast Asia and East Asia that are facing some shortages. But honestly, I don't think so. I mean, that's you're talking about a water balloon. What's needed is a hose. What we need in the oil markets right now is for the Strait of Hormuz to reopen, for us to see ships passaging back through it, picking up oil, bringing it back out to the market. We need to see countries like Kuwait, like Saudi Arabia, like Iraq start to bring up their production to historic levels again. Until that happens, I think the market's going to be real on tenterhooks, and traders will be living headline to headline like they have been for the last 36 hours. So we really need to see the physical flows start to return to normal. And despite any comments we've heard over the last 36 hours, there's no sign of that happening yet.
Dan, the prospect of Trump easing oil sanctions, if it does indeed happen, I mean, is there an actual possibility that we might be using Russian oil soon?
There's certainly a possibility, right? I mean, Trump can do whatever he wants to with those sanctions. That's at the discretion of the president. It would seem unlikely for all the efforts that the U.S. and its allies have taken over the last couple of years to remove it just because oil goes up above $100 a barrel. But there's no way of knowing what his intentions are in the future. The one thing we do know is that there are midterm elections coming up this fall, and Trump, cost of living is at the top of his mind, and every American voter drives by about 30 gas stations every day, and so the price of gasoline is something that they gauge whether he's battling inflation by. So he'll definitely be trying to take steps to make sure that oil prices are a lot lower than they are now.
All right, we'll see what happens next. Dan Murtaugh, thank you so much for joining. Stocks in Asia rebounding today. Let's get an update now from Winnie Su in Hong Kong. A green day, Winnie.
Yeah, morning, Bonnie. As you can see, it is a very nice relief rally that we are seeing in Asia, coming off President Donald Trump's comments, as well as oil also coming off as well. But overall, it is really still not that full risk-on environment, as we're seeing that MXAP actually coming off some session highs, now just 3% to the upside. And when it comes to Japan's Nikkei 225 and Taiwan's TAIEX index, both up about 2% after entering that technical correction territory yesterday. So overall, still quite some volatility. And you flip the board and take a look at what's going on in the South Korean market, because Kospi here driving gains in Asia up more than 5%, with chip makers Samsung Electronics and SK Hynix leading gains up both double-digit earlier today. And lots of optimism is actually building in for these stocks after valuations come down about 25% since its January high, while the outlook for AI and memory chips really hasn't changed as much. We also want to take a closer look into the Chinese assets, because when it comes to the stocks space, not too much moves, up about just 1% onshore. But interestingly, offshore, we are looking at tech stocks driving gains, specifically Tencent here up about 7%. And that's coming after the company released a new AI agent called WorkBuddy, which is actually fully compatible with China's OpenClaw. And that is Citi actually citing it as a potential new inflection point for China's AI agent. So lots of optimism around the tech front. Last but not least, when it comes to the onshore yuan here, strengthening 0.4% with a PBOC stronger fixing, a weaker dollar, and also some strong trade data coming off from the export and import side. Back to you, Bonnie.
Winnie, thank you so much. Winnie Su there, giving us an update in Hong Kong. MLIV says equities could be facing further declines with higher oil prices set to weigh on corporate profits. Let's bring in Mark Cranfield, cross-asset strategist at Bloomberg MLIV. Mark, downside risk, and it's not just the Iran war that's weighing on sentiment. Ed Yardeni with some more great comments today. He's talking about how central banks are being thrown for a loop because now they have to add in things like stagflation concerns, supply line concerns, and more into their monetary policy path forecasts.
Yeah, absolutely. Just before I came on air, the Reserve Bank of Australia, Mr. Hauser, was speaking today, and he's talking about inflation and how it's such a dreadful thing for the economy that it will be very dangerous if central banks don't get on top of it. RBA meets next week. Several central banks meet next week, and the Reserve Bank of Australia has been one of the quickest to raise interest rates in this cycle. People will be watching that very closely because it sounds as though he's one of those people that's going to favour an interest rate hike next week, and he may get some influence on other central banks if they move quickly. So clearly, it's top of the mind for major central banks around the world, and traders are aware of this. And if you look at, there might be some green on the screen today, as Winnie was showing earlier. But if you look back just over the past week or so, bond yields are still high around the world. Oil prices are still very elevated. And if you look at Brent trading in particular, it's in a much higher trading range than it was before the war started. So for now, nobody wants to take away that risk premium that they've built into the price of oil in case there's a continuation of the hostilities. And even if it was to suddenly change and everything was to go calm, people are not going to reduce oil prices all that much because they see the supply chain risk as still being extremely high. So all of that needs to be priced into the equity market as well. It is not the scenario that people started the year with. We had a much better start to the year. If you look at Asia, Korea, Taiwan, stocks are flying high. Suddenly, they're having to rebalance in the face of this inflation threat, higher interest rate threat as well, and currencies in turmoil. So all of those things together are changing the outlook dramatically, and we're coming towards the end of the first quarter as well, when people really have to assess where they want to go. It is not a great environment for increasing risk. It is more likely people will want to continue to retrace, and that most likely means they're not going to be adding a lot of equity exposure right now. They'll be backtracking, and that probably means that they have to be a bit more downside between now and the end of March.
Oh, wow. Mark, thank you so much. Mark Cranfield, cross-asset strategist at Bloomberg MLIV. Still ahead, investors whiplashed as the US president signals an end to the war in Iran. We'll unpack more of the market reaction later. But first, the G7 signals it's ready to take action to support the oil market. We'll discuss all that next. This is Bloomberg. Welcome back to Daybreak Europe. Aramco has announced a $3 billion share buyback and raised its dividend after reporting full-year operating profit that missed estimates. The world's biggest oil exporter has faced a series of setbacks this week, including being hit by an Iranian drone attack. The company is also rushing to reroute oil exports as the Strait of Hormuz remains at a near standstill. Meanwhile, a group of 7 finance ministers said they are ready to take any steps needed to support global energy supply, including releasing strategic oil reserves. France's finance minister said the group was, quote, not there yet in terms of an actual release, but that it was monitoring the situation closely.
We're not there yet. What we've agreed upon is to use any necessary tools, if need be, to stabilize the market, including the potential release of necessary stockpiles. The work is going to keep on being done in the next couple of days. The International Energy Agency was with us, so we're going to keep on working. I think they're having a governing vote tomorrow, and we obviously will keep you posted as we keep on working.
Joining me now is Humayun Falak-Shahi, head of crude oil analysis at Kepler. So, Humayun, the numbers that are being spoken of are 300 to 400 million barrels. I presume that would be maybe all at once. How would it work? And put that into context for us. Is it a lot?
Good morning, Bonnie. I think this is actually quite significant. We're talking about 400 million barrels. As you said, the key element is how fast will this be released, if it is to be released. And I think, if you look at the past SPR releases, such as from 2022, it was very gradual. But here this time, I don't think the market has the ability to wait for this to be gradual like in 2022. So I would say that if any release has to happen, it has to be relatively sudden compared to a gradual release, and that would be very important. In terms of the importance, 400 million barrels we estimate is roughly around 45 to 50 days of supply losses that we are currently seeing happening from the Middle Eastern countries, because you still have some exports from Saudi Arabia, from the UAE, which are partially able to bypass the Strait of Hormuz, and obviously from Iran, which is also continuing its own exports. So it's not like we have lost total exports from the Persian Gulf, but I would say roughly half of that, so more or less around 8 to 9 million barrels per day of loss, and that's how we came up with the estimate of 45 to 50 days. So the key question is, how long will this war last? If it's more than 45, 50 days, then it won't be enough.
If President Trump does waive some sanctions, have you thought about what kinds of sanctions he might waive and how many barrels that would mean if he were to be, waiving some Russian oil sanctions, for example?
Yeah, it's still uncertain what he exactly meant by the lifting of sanctions, but it appears like he probably was referring to Russia. We've already seen a waiver being granted to Indian buyers of Russian crude. Not that they were not buying before, but they actually reduced their buying of Russian crude in the past 3-4 months since the sanctions on Rosneft and Lukoil in October last year. And so this already triggered a huge increase in buying from Russian crude. So we think that Russian crude going into India used to be around 1.7 million barrels per day and then dropped to closer to 1 million barrels per day. And now we think that it's probably going to go back to 2 million barrels per day in March and April because of that urgency, especially coming from India, because India has limited storage capacity, and obviously it also relied a lot on Middle Eastern crude. But yeah, I think looking at other types of sanctions lifted, I probably will be focused on Russia and probably allowing other buyers such as the Europeans or other refiners to buy Russian crude as well.
Yes. How How long does it take for shut-ins to get reversed, or at least the shut-ins that we have seen? The fact that even Saudi is shutting in some areas now, and that Qatar is effectively not completely shut in, but basically majority shut in. If they can get the infrastructure into a situation where they might be able to start producing again, how long does that process take?
I think it depends on a few factors. The first one is whether the field is fully shutting or just brought to a bare minimum. It does make a difference because when a well gets fully shut in, then you lose a bit of confidence and data, in terms of how much can come back. But I would say that looking at the region, we're talking about fields that sometimes have been producing for decades, and the engineers in the region have a really good understanding of how those fields work. So I'm pretty confident that actually when all this is over, we'll see production come back very fast. I would say probably a matter of days or 2 weeks maximum. But again, it depends on whether the field would be fully shut in, but also on how long they would be shut in. If you shut the fields in for more than 2-3 months, I would say, then it becomes a bit more problematic and maybe it would take a longer time. But otherwise, I would say just a matter of days or 2 weeks maximum.
You mentioned that Iran is still loading at Karg Island, in fact, elevated levels. But are those shipments going through the Strait of Hormuz? Are they able? We're also seeing huge clusters of ships at the Strait of Hormuz, which means there's signal jamming, obviously.
Yes, actually, indeed, Iran is continuing to load from Karg Island. Interestingly, they've also loaded one cargo 2 days ago from Jask, the port of Jask, which is outside of the Persian Gulf. It is on the Gulf of Oman. So they're also themselves bypassing the strait to an extent. And the other cargoes that have loaded from Karg Island, yes, they are passing through, but it's been only 4 or 5 cargoes. Actually, in the past week, in the past 8 days, we've only seen 6-7 cargoes pass through the strait. I mean, exiting the Persian Gulf, and a few of them were Iranian cargoes. So yeah, these cargoes are actually passing through and heading towards China, their only market.
Humayun, we have to leave it there, but please do come back soon with your analysis. Humayun Falak-Shahi, head of crude oil analysis at Kepler. Coming up, Anthropic sues the U.S. Defense Department in the latest stage of its spat with the Pentagon. More on that next. This is Bloomberg. Now to other top stories we're following this morning. Anthropic has sued the U.S. Defense Department for declaring it a risk to the American supply chain. The declaration was made after Anthropic refused to bow to Pentagon demands for it to remove safeguards on its technology. The AI giant says it's being excluded from government business for disagreeing with the U.S. administration. The U.S. and Russian presidents have spoken on the phone for the first time this year, discussing the war in Iran in a call that lasted about an hour. Donald Trump and Vladimir Putin also discussed U.S.-led peace talks between Ukraine and Russia, which have stalled since the Middle East conflict began. President Trump subsequently said he's considering easing some oil-related sanctions. Australia has granted humanitarian visas to 5 Iranian footballers who sought asylum. The players say they feared for their safety after refusing to sing the national anthem before an Asian Cup match last week. Australia says similar assistance will be offered to the rest of the team. Coming up, a wild week for markets so far, and it's only Tuesday. We'll dig in next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. Oil slides, stocks rebound as President Trump says the war in Iran will be over very soon, though not this week. The U.S. president says he may lift some oil sanctions to ease prices, acknowledging he discussed the topic with Russia's President Vladimir Putin. Plus, in earnings, Saudi Aramco surprises with a $3 billion share buyback as the world's biggest oil exporter looks to navigate the hostilities in the Middle East. We're also live at Volkswagen's headquarters for its full year results. So let's take a look at these markets. Oil, as you can see, much lower, but it is coming off its lows of the session now. So we're a little higher than we were just an hour ago. Panic selling and buying is what one trader told us yesterday. Obviously, we saw huge swings in the oil market. We were up at 120 before the market opened yesterday morning. And obviously now we're down to 93 on Brent crude. We'll see if that holds. Lots of promises out there, lots of ideas out there, but is anything actually being implemented, and how long would it take to implement something if it does come to that? Well, they're all outstanding questions. For the moment, the market is content with the promise that something will ease the pressures that are coming down the pike. The 10-year yield back down to 4.11 as well. All markets seem to be reflecting this calm. If we take a look at equity markets, yesterday the SOX index bounced more than 4% in the United States. The Nasdaq 100 was up more than 1%. We'll maybe hold on to some of those gains today, although right now S&P futures are pointed lower. Euro Stoxx 50, though, pointed much higher, so it looks like Europe might be doing some catch-up. The dollar index also showing a little bit of that calm. It's down about 0.4% as traders look for those risk-off trades or potentially, less frightened trades. Time now for your front page news, though. The Financial Times is asking, can the G7 release enough oil to calm the market, with skepticism from analysts that reserves will solve the problems in the Gulf? The Wall Street Journal leads with the headline, Trump advisors urge him to find Iran exit ramp, fearing political backlash. And Les Echos is focusing on President Macron advocating for a more public and private capital towards nuclear energy. This all against the backdrop of soaring energy prices due to the Iran war. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBeGo. So, the Iran war is forcing central banks to consider yet another supply shock, with traders ramping up bets on rate hikes from both the ECB and the Bank of England. With me now is Camille de Courcelles. She's head of Developed Market Rate Strategy and Europe Economics at BNP Paribas Markets 360. Camille, thanks so much for joining. How much more complicated is the conversation now for the major central banks? Let's start with the Federal Reserve.
I mean, for the Federal Reserves, as any other central banks, in fact, for what's happening in Iran, they should normally take this as temporary, but what will matter really is the duration of the shock and whether inflation expectations remain well anchored. So that is key for central banks around the globe. But the longer oil and gas prices remain at elevated levels, the greater the risk that inflation expectations start to disanchor, and therefore the greater the risk that central banks may need to act.
Has any lasting damage already been done? So say the president is right and this war, quote unquote, comes to an end, whatever that looks like, in about a week's time. Is there any lasting effect for the likes of the Federal Reserve or the Bank of England or the European Central Bank?
If it were in just a week, a couple of weeks, so just a few weeks more time where we are at elevated prices, I don't think it will matter too much for central banks, whether it's the Fed, the BOE or the ECB. Again, here the duration would be too small. You will have a spike in inflation in March, most likely, yes, because the impact will last for several weeks there, but then it should rapidly come down if we have a sufficient decline in oil and gas prices.
So we were just looking at markets there, and we see that there's a little bit of calm coming into the market, but we know that these markets can flip on a dime, right? What are options markets telling us right now? Where and when, let's say, is peak risk?
I mean, that's clearly an important question mark. Peak risk, peak volatility. Have we seen the peak in oil and gas prices already? I think it's too uncertain to tell. Volatility has, as it had to do, rebounded from the lows, but volatility will most likely remain from here because there is still a lot of uncertainty. As you were saying, Trump is calling for an end pretty soon, but what will be the stance in Israel, in Iran, with the new supreme leader? Is there appetite for them as well to end the conflict? So for volatility to really go back to where we were before, I think it will take a lot more time.
Yeah, we're just looking at the MOVE index and how elevated it's become, although nothing like what we saw, when Russia invaded Ukraine, let's say. So what's your base case for, let's say, the major developed markets? Do we continue to see a little bear steepening, or is it just too early to say?
So our view has been from the beginning that in this sort of supply shock, you are in a stagflationary regime, which is typically a flattening on the curve. So you have commodities leading the price action, so higher front-end break-evens, higher front-end yields, and flatter curves. So we've been quite quick to shift our positioning last Monday. From here, it very much depends if indeed it's just one more week, or let's say 2 more weeks. We could see a rapid unwind of all this stagflationary positioning that have been impacting the curve. But the question is
now, BNP Paribas is poised for stagflation. So what does that mean? I mean, are we looking at serious, risks to, say, the U.S. economy and the major economies?
This is an important risk, I would say, especially for Europe, because of gas being a particularly important issue there. So for the UK, for the Eurozone, it could be an important hit on GDP. Our take is that it's less bad for the US, where they have their own oil production, even though you have second-round effect with AI and so forth. But for us, it's more negative, clearly, for Europe compared to the US.
So what should the market be pricing in? What is it telling us right now, the way it is priced? We're seeing it in the United States, for example, price less of a 50% chance of a cut at each next meeting, where that was not the case before. We're also seeing shifting prices for the ECB.
Yeah, that's where I would say we take a bit of a different stance. For us, the Fed, or the pricing of the Fed, should have unwound a lot of these cuts because US inflation is already running well above target. So if you add a shock to that, then you reach a point where perhaps we go back toward 375. At 375% on inflation, we think the Fed should hike. And we are in an economy which is already reaccelerating. Now, the latest NFP report is, easing that view a little bit. But I would say, yes, the Fed, very high inflation, where when it comes to the ECB, though, inflation was well below target before the conflict started. And therefore, even with this massive repricing we've had in inflation break-evens, we don't think we are at levels anywhere close to an ECB action anytime soon.
Too optimistic to say that it's good timing then? Because if anything, it's probably going to hit the European economy faster than the United States economy, given gas prices and oil prices. I mean, obviously oil prices are hitting the US economy, but if gas really, starts to be a problem, it's Europe that really hurts first.
Correct. Which therefore reinforces the view that the ECB might not need to respond as much as the Fed. But yet the market is still pricing cuts for the Fed and pricing hikes for the ECB. Although I think one reason is probably because there was so much long positioning at the front end of the euro market that all this unwind has created this pricing of hikes for the ECB.
All right. Well, BNP Paribas, obviously very nimble these days. Camille de Courcelles, thank you so much. Camille is from BNP Paribas Markets 360. The latest data from the UAE is suggesting that Iran's barrage of missiles and drones has dropped, though it's unclear why or if that trend will continue. Bloomberg Economics defense lead Becca Wasser has been looking at how the conflict is draining stockpiles of U.S. weapons, and she joins us now. So we mentioned some data from the UAE. Just give us the broad picture.
So the UAE has received the majority of Iran's ballistic missiles and drone attacks since the start of the conflict. And we have seen a precipitous drop in the ballistic missile attacks, although they do continue, suggesting that some of the U.S. And Israeli strikes on Iran's missile program, particularly its missile launchers, has been effective. That said, Iran has shifted to sending more and more drones across to the UAE, but that too is down, in part for very similar reasons. Even though drones don't require dedicated launchers, you do need forces that move out into the open, set up, and fire, and that makes them potential targets. So it's been a little bit difficult for Iran to continue to have its barrage of missile and drone attacks at the same levels we saw initially in the conflict. That said, I think it's more of a shift in what's happening on the ground than it is them running out of potential missiles and drones, because drones are cheap and relatively easy to produce, and is something that Iran really focused on trying to replenish after the 12-day war.
Right, and are there places from where Iran can continue to replenish these and other types of stockpiles?
Well, I think Iran has probably done a good job of trying to distribute some of its drones throughout its country and to different groups. There's also a question of whether they've distributed some of its drones and other capabilities to some of its proxy organizations across the region, from Hezbollah to the Houthis. There's also open questions about some of the materiel that they could get from other groups and other alliance states, whether that is Russia, which it has frankly proliferated its Shahed drones to, and Russia has perfected calling the Jiran 2, which it's used to great effect in Ukraine, but also a question of whether they can maybe get some spare parts from China. But the question is, how can those get proliferated to Iran at this juncture in time when Iran is under extreme fire from the United States and Israeli strikes?
And also its proxies. Do we have any evidence whether they're continuing to get restocked, or if in this kind of a scenario they are sort of giving back maybe some of what they had been stocked with?
Well, Hezbollah has been very busy on Israel's other front, and that continues to be an ongoing conflict that hasn't necessarily gotten the same kind of attention that we have for the Iran war, but that is still ongoing. So I don't think they're trying to give away any of their capabilities at this point in time, because they're firing them and they need them at this point. However, the Houthis have been relatively quiet. Initially, at the start of the conflict, they said that they were going to respond and get involved, and we haven't seen that quite yet. So I'm waiting to see how and if they get involved, and if so, are we going to potentially see a repeat of some of their risky maneuvers in the Red Sea, some of the harassments and drone attacks that they used to great effect on U.S. warships and commercial shipping? And if so, how is that going to further ensnarl some of the tension that we are already seeing in the Strait of Hormuz?
And of course, the U.S. only has a certain amount of stockpiles of things too. I mean, companies like Lockheed Martin, they make a certain amount per year of what they make, right? And they can't up production very easily. I'm curious, has any thought been put into other kinds of assets, as grotesque as it might sound, that Iran might use if it were put in that position, that it didn't have the military assets?
I think there we've seen historically conflicts, even if you run out of materiel, there are different ways of adapting and continuing the fight. So I know often we're using, does Iran have enough missiles left? Can the U.S. continue to prosecute this fight, almost as a stand-in for how long can this go on? And at the end of the day, materiel alone is not the thing that's going to win the war. If you're going to end a war, it's often because of political will. And I think that's what we're seeing right now with President Trump's comments, where he's kind of playing both sides of the same coin and saying, well, we could end this very soon, but not this week, or we could continue to strike Iran quite hard. At the end of the day, it's a political question to terminate war, not necessarily a material one.
And Iran keeps saying that it has ways that it can surprise the United States. So that in itself is a big threat. Becca, thank you so much. Becca Wasser is defense lead for Bloomberg Economics. Coming up, Volkswagen reports full-year earnings. We're live at the company's Wolfsburg headquarters next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some corporate news. Renault is planning a new lineup dominated by electric vehicles, just as consumers face higher fuel prices at the pump. 16 of the 22 vehicles being introduced in Europe by 2030 will be EVs. The CEO, François Provost, is under pressure to improve sales amid rising competition from Stellantis and Chinese rivals. Apple increased iPhone production in India by about 53% last year to get around U.S. tariffs on imports from China. The company now makes a quarter of its iPhones in India. That's around 55 million devices. The country has offered subsidies to help offset some of the structural cost disadvantage that manufacturers now face. CATL's full-year profits surged as the company boosted overseas sales, weathering a brutal price war in China. Revenues while net income jumped 42% year over year. The EV battery maker banking on new technologies to drive demand, including the commercial rollout of its second-generation sodium-ion batteries. And just another note on earnings, Volkswagen came in with a full-year operating profit miss. Also, full-year earnings missed estimates. Now, the return on sales may be okay. 4 to 5.5% is the forecast versus the estimate for 5.23%. So a little bit lower than may have been expected, given that we're very close to the top end of the range there for estimates. Now, Oliver Crook, Bloomberg's chief Europe correspondent, is at Volkswagen's headquarters in Wolfsburg in Germany. And I should say a 50,000 person firing as well. That's what they are telling us, that they're going to lay off 50,000 people in Germany. So, Ollie, what do the earnings tell us about the actual state of European industry and the risks posed by the Iran war?
Yeah, so listen, I mean, if this earnings release, if you're looking for sort of encouraging signs for the German economy, you're not going to find them in the earnings release here from Volkswagen. We should go through some of this. There's a lot of dense information to go through. But in terms of operating results, we're talking about the worst operating result for Volkswagen since Dieselgate back in 2016. When you look at the margins that they reported for 2025, operating margin at 2.8%. Again, they have not seen a figure that low since back in 2015 when Dieselgate, again, was completely wrecking their earnings and their margins went negative. But again, there is no massive scandal here at Volkswagen. There's nothing sort of hugely specific to Volkswagen that there's a problem. There are a couple one-off costs for changing their strategies at Porsche. They've taken a massive write-down on a number of costs because of Porsche and Audi, about 9 billion euros. But there's not a sort of seismic event. This is just the macro picture for the auto industry right now, and you're seeing it sort of illustrated in the earnings. And I want to go through a couple of the other numbers. We look at the Porsche numbers. The margins for Porsche in 2025 were at 0.3%. That means that they made basically no money at all on selling Porsches last year. This obviously is a sort of, generally speaking, one of the more sort of margin-rich areas for Volkswagen. They went down from 14.5% to effectively a margin of 0% on Porsches. Now, this is down obviously to the market in China certainly for Porsche and for a number of other sales for Volkswagen. Of course, the U.S. tariffs are a major part of this picture. They sold that being said, they did sell 9 million vehicles last year. They did manage to eke out some growth in Europe. They had about 5% growth in Europe and South America, about 10%. But again, the markets that really matter to Volkswagen, yes, Europe is one of them, but another one is China. Sales down 6% and down 12% in America, in North America. And that is, again, down to what we've been seeing from the tariff war. And now we see the real resorts coming through to the P&L for Volkswagen here.
Well, you're definitely going to hear more later, Ollie, but I'm curious, so far, is there any indication of the war's potential impact on things like input costs and even demand?
So that's going to be the main focus of my conversation a little bit later with the Chief Financial Officer, Arno Antlitz, to really start to get our arms around basically what the impact of this war is for the European economy, for a major producer like Volkswagen. Some of the reporting that we've done from what we understand is that there could be real concerns in terms of the supply chain, in terms of aluminum deliveries. Are they getting what they need to actually produce the cars? There's obviously the question of input costs for the energy sector within industrial Germany. We know that in Germany, it's about 20% of the economy is industry. We know how sensitive this is to a sort of surge in prices of oil and, of course, critically of natural gas. And so we're going to try to see kind of how he sees this going. Obviously, there's going to be a major impact potentially on consumer sentiment. So it's not just the input cost of the car, but actually to the downstream, to the consumer. And we look at the sort of the guidance that they've put out. They said that they're going to get potentially their revenue is going to go from 0 to 3% increase next year. That is the range. So it could be basically dead flat. They're sort of guiding guiding potentially a little bit optimistically on the margins to bounce back to between 4 and 5.5%. But again, these are forecasts that are basically dependent on things not changing radically in terms of the tariff regime. We know the Trump administration is somewhat satisfied with the tariff regime as it is, so maybe that won't change. But again, the geopolitics could just throw a wrench into all of this sort of recovery here for Volkswagen and indeed for the German economy. And that's why everybody's going to be watching this very, very closely and seeing how it develops over the next few days. And for Arno Antlitz, the CFO, it's going to be absolutely crucial. So we're going to get a little bit of insight from him a little bit later today.
Yeah, can't wait for that conversation. That's Bloomberg's chief Europe correspondent there, Oliver Crook. And Ollie has an interview, as he said, with Volkswagen's CFO, Arno Antlitz. Catch that conversation just after 8 a.m. London time. Plenty more coming up. This is Bloomberg.
We're also waiving certain oil-related sanctions to reduce prices. So we have sanctions on some countries. We're going to take those sanctions off till this straightens out. Then who knows, maybe we won't have to put them on. There'll be so much peace. But when the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed.
The U.S. president seeking to reassure markets yesterday, and for a time he did. In fact, if you take a look at the oil chart, we saw 3 swings of 10% yesterday. I'm not sure that has ever been seen before. As one trader said, it was just panic trading yesterday. As you can see, a swing down by 10% and then a swing back up by 10%. And today we're lower once again. The market continues to be calmed, but at the same time, we're not as low as we were earlier on this morning. Let's take a look at Treasury volatility, because we're seeing something similar there. An elevated MOVE index. As you can see, we're right up to almost 80 on the MOVE index. Now, that said, back around the Russia-Ukraine war, we saw that much higher still. I think the index got to about 140, but you can see how much we have come up. And then I just want to point to another interesting chart. China is starting to see inflation. Now, this will add another wrinkle to the global economy, not just to China's economy. So China had been exporting deflation, and that was, if anything, a little bit helpful perhaps to the rest of the world. Well, as you can see, we are now starting to see inflation in China. You're seeing it as well in Chinese bond prices, and of course, the central bank keeping an eye on yuan fixings as well. You can access all these charts, search them, save all of them on the Bloomberg terminal. Not just the charts used on this show, but across Bloomberg TV, terminal subscribers can now use the brand new function, CHRT TV Go. All right, there are some more risk events on your agenda today. The EU finance ministers are meeting in Brussels. Then at 2 p.m. UK time, we get US existing home sales. And aftermarket, we have Oracle earnings. Don't forget the SOX index was up more than 4% yesterday. Don't forget, too, we'll be speaking with Volkswagen CFO just after 8 a.m. London time, so stay with us for that. The opening trade is next.